This is a BC Eagle accounting video. Why variable costing makes sense when the number of units produced differs from the number of units sold. This is a second video in a two-part sequence on variable costing. This video explains some of the details about why businesses use variable costing, specifically in cases where the units produced differ from the units sold. As you will recall, variable costing is an internal use only costing system where costs are isolated by cost behavior. Only the variable costs become part of work in process, and all fixed costs are expensed in the period that they are incurred. Absorption costing, or GAAP accounting, is what is required for external financial reporting purposes, and it includes all manufacturing costs, both variable and fixed manufacturing costs, in the work in process account. An issue that decision makers have with variable costing is that it unitizes fixed manufacturing costs per unit, which is not good for decision making. The key to business decision making is that to control a variable cost, a manager would make decisions about the volume of production. To control fixed costs, the manager makes decisions about the time. Now, let's look at this scenario where we have a company that just began operations in period number 1, so it has no beginning units in process, and it has operated for 3 periods. And we're going to set this up so that the operating characteristics for all 3 periods are the same, except for the number of units produced. So in period 1, the company produces 15,000 units and is able to sell all 15,000 of those units, so its ending finished goods units at the end of period 1 are 0. In the second period, it produces 20,000 units and only sells 15,000 units, so since units produced exceed units sold, it has an ending finished goods of 5,000. That 5,000 ending inventory in period 2 will be the beginning inventory for period 3. The company produces 10,000 units but sells 15,000 units, so it produces fewer units that it sells, but because it has beginning inventory, it doesn't have any ending inventory at the end of the third period. The selling characteristics are that the selling prices are $50 for each of the 3 periods. The variable manufacturing costs for direct labor and direct material are $25 a unit for each of the 3 periods. The variable selling, general, and administrative expenses are $5 each period. And remember, any selling, general, and administrative cost is expensed in the period that they are incurred, whether we are dealing with absorption costing or variable costing. Fixed manufacturing is $150,000 for each of the 3 periods, and fixed operating, selling, general, and administrative, which is always expensed whether you're a variable costing or full absorption costing, is $50,000 at the end of each of the 3 periods. So here is the setup that we have for this illustration. Because the selling prices are the same, and because the operating and the manufacturing costs are the same for all 3 periods, we should see fairly consistent operating performance on the income statement for all 3 periods, right? Well, that doesn't always happen, and here is an illustration. Let's see the results for full absorption costing under each of these 3 scenarios. So here you have it. When production equals sales, the full absorption costing would report 15,000 units times $50 sales per unit, so $750,000 of sales. The total cost added would be, for variable manufacturing, $25 a unit times the 15,000 units produced, or $375,000. we would add the $150,000 of fixed manufacturing for total costs added and total cost of goods manufactured of $525,000. Because all the units produced were sold, there is no ending inventory, zero for ending inventory, so the cost of goods manufactured equals the cost of goods sold. Cost of goods sold, $525, from the sales of $750,000 produces a gross profit of $225,000. Deducting the variable selling and administrative costs, $5 a unit, times 15,000 units sold, gives $75,000. And deducting the fixed selling, general, and administrative costs give $50,000. So $125,000 of selling, general, administrative from the gross profit of $225,000 produces $100,000 of operating income. So far, so good. Now, let's take a look at the second year where the number of units produced exceeded the number of units sold. In the second year, the sales would still be 15,000 units times $50 a unit, or $750,000. Variable manufacturing costs, though, would go up because 20,000 units were manufactured at $25 for $500,000. Fixed manufacturing costs would stay the same at $150,000, so total costs added, $650, would be the same as total cost of goods manufactured because there would be no beginning inventory. Cost of goods manufactured would be less than cost of goods manufactured because of the ending finished goods inventory. Now, let's calculate the ending finished goods inventory. We would have 5,000 units in ending finished goods inventory that we would have to cost. We know that each unit has variable costs of $25,000, but how much would we have in fixed costs? Well, we know that we have a total of $650,000 of manufacturing costs that we need to spread over 20,000 units produced. That gives us a manufacturing cost per unit of $32.50. Get your calculators out and take $32.50 times the 5,000 units in ending inventory, and that should give you $162,500 as the ending finished goods. Ending finished goods from cost of goods sold or cost of goods manufactured produces the cost of goods sold of $487,500. Cost of goods sold of $487,500 from $750,000 of sales gives gross profit of $262,500. Deducting the variable selling, general, and administrative expenses, the company sold 15,000 units, the same as it did in the first period, at $5 a unit, so that would be the same $75,000. And then fixed operating costs, selling, general, administrative, are $50,000, so deduct 75 and 50, $125 from the gross profit of $262,500, and that gives $137,500 as the operating income, or EBIT, earnings before interest and taxes. Here is something for critical analysis. Why is it that when the number of units sold each period are the same at 15,000 and the cost structure, selling price for both periods is 50, manufacturing cost variable for both periods is 25, fixed costs in total for manufacturing 150, and fixed cost for selling, general, administrative $50,000 for both periods, all that's the same, why is the income different? Okay, well, that illustrates an issue with full absorption costing. Because full absorption costing buries some of the fixed manufacturing costs in ending inventory, full absorption costing does not display all of the fixed costs incurred during the period on the income statement. Some of it is reported as ending inventory, it can overstate profits in periods where number of units produced is bigger than the number of units sold. A little bit later, we will show you how variable costing corrects that. But for right now, let's carry through this example to the third period where the beginning inventory would be 5,000 because of the 5,000 left over from period 2. The company only produced 10,000 units but sold the same 15,000. So the number of units sold was bigger than the number of units produced. Let's see what happens. Sales at $50, 15,000 units at $50 would be 750,000. We would have beginning finished goods inventory of 162.5. The company would add 10,000 units produced times $25 manufacturing cost per unit for variable costs, 250,000. It would add $150,000 of fixed manufacturing for total cost of goods manufactured of $562,500. Now, because we had beginning inventory of 5 and we produced 10,000 units for a total of 15,000 units available, we sold 15,000 units, there would be no ending finished goods inventory. So 0 for ending finished goods inventory. The cost of goods manufactured would equal the cost of goods sold. Cost of goods sold, 562.5 from the sales of 750,000 produces gross profit of 187,500. Because the company sold again 15,000 units, the selling, general, and administrative expenses would be the same as in the previous period. So deduct the total of 125,000 of selling, general, and administrative expenses from the gross profit, 187.5, and you get $62,500. Wow! In this third period, the income is less than the other two periods, despite the cost structure being the same, and despite the selling price being the same, and despite the company selling the same number of units. Okay, so you can see by manipulating inventory, by producing a whole lot, a manager has the potential to increase income and maybe get a bonus for himself or herself. That's a problem with using absorption costing for managerial decision making. It can cause managers a bad incentive to produce too much so that fixed costs are taken out of the income statement and buried in ending inventory, and profits may be overstated. Let's take a look now at what absorption costing does for the manufacturing process. What variable costing does is to expense all fixed manufacturing costs in the period that they incur them. And here's the key point that we'll point out first. When sales are constant, you can see the sales constant at 750, and when the variable manufacturing cost per unit stays the same at $50 a unit, and when the other items in the cost structure stay the same, income stays the same based on sales. And so that is what variable costing does. It eliminates the bad incentive for managers to bury costs in ending inventory because all fixed costs are expensed regardless of the number of units produced. Now let's take a look at the mechanics behind variable costing. Each year, sales would be 15,000 units at $50 a unit, or $750,000 in total. Variable manufacturing inventories or capitalizes only the variable manufacturing costs. So for the first year, there would be 15,000 units produced times $25 per unit, or $375,000 of variable manufacturing. In the second year, 20,000 units produced times $25 a unit would produce $500,000 of variable manufacturing costs. And in the third year, 10,000 units were produced at $25 variable manufacturing cost per unit. That produces $250,000 of variable manufacturing. Going back to year one, the ending inventory would be zero because the company sold all the units that it produced. So the cost of goods manufactured would equal the cost of goods sold. Variable cost of goods sold plus the variable operating costs, 15,000 units sold times $5 a unit, or $75,000, from sales, 375 plus 75,000, from the sales of 750, give you contribution margin of 300,000. Subtract fixed manufacturing and subtract fixed selling general administrative gives $100,000 in operating income, or EBIT. Let's take a look at the second year. In the second year, we've already calculated $500,000 of variable cost of goods manufactured. Now, what would be the ending finished goods inventory? Finished goods inventory would be 5,000 units, and only the variable manufacturing cost of $25 a unit would be part of ending inventory. So 5,000 times 25 produces ending finished goods inventory of $125,000, as shown to you in this table here to the right. Ending inventory of $125 from the cost of goods manufactured produces the variable cost of goods sold. Deduct the variable operating expenses, $75,000, and then deduct the variable cost of goods sold and the variable operating costs from sales of $750, produces the same contribution margin of $300,000. Deduct the fixed and the selling and the fixed manufacturing and the fixed selling general administrative costs of $225, and you $200,000, and you get $100,000 of EBIT. Okay, so as you can see, what variable costing does, when sales and production costs are the same, profit will be the same. And finally, let's take a look at the third year, when production is less than sales. The ending inventory in the last period would be zero because the company sold all of its beginning inventory plus all 10,000 units that it produced. So the variable cost of goods manufactured plus the beginning inventory would equal the variable cost of goods sold. Deduct the variable operating costs, and that would produce the contribution margin of $300,000. And as you can see, the same contribution margin less the same fixed manufacturing and fixed selling general and administrative costs produce the operating income of $100,000. The takeaway point from variable costing is that it eliminates the incentive for managers to overproduce to hide fixed costs in ending inventory. Variable costing expenses all fixed costs in the period that they are incurred to eliminate that type of incentive. Variable costing only inventories the variable manufacturing costs. The third topic in this video is reconciling variable costing income to full absorption costing income. Now, when we produce the income under full absorption, you can see that we had $100,000 in the first period, $137,500 in the second period, and $62,500 in the third period. Under variable costing, we had $100,000 of income for each period. And so if we would compare full absorption costing income to the variable costing income, we would find these differences. In period 1, where the units produced equaled the units sold, there was no difference between variable costing income and full absorption costing income because either system would have expensed all $150,000 of manufacturing costs. There was no ending inventory in which to hide those fixed manufacturing costs. In the second period, there would have been 5,000 units of ending inventory to hide some of the fixed manufacturing costs. So there is a $137,500 less $100,000, $37,500 difference between variable costing and full absorption costing. Full absorption costing was $37,500 more than variable costing. And in the final year, operating income under full absorption costing was $62,500. We had variable costing of $100,000, so variable costing showed $37,500 more income than absorption costing because under full absorption costing, some of those fixed costs that were incurred last period and buried in last period's ending inventory were released into the income statement in the third period. So more than $150,000 of manufacturing costs were released to the income statement in period number 3. Accordingly, full absorption costing income would be less than variable costing income when the number of units sold exceed the number of units produced. The takeaway point here is that it's always possible to reconcile absorption costing income with variable costing income by calculating the amount of fixed costs that would be in the ending inventory. And in this case, in year 2, absorption costing profit was $137,500. The amount of fixed costs allocated to ending inventory would be the 5,000 units in ending inventory times the fixed manufacturing costs of $7.50 in ending inventory for period 2, or $37,500. For period 3, absorption costing has $62,500 of income. The fixed costs in ending inventory that would have been buried in the previous period are now released under full absorption costing. So full absorption costing understates income. We add back that excess fixed cost incurred last period, $37,500 onto $62,500, produces the variable cost EBIT. There you have a long-winded explanation about why variable costing is useful for business decisions. To recap one more time, variable costing is useful because when the sales structure is the same, the number of units sold is the same, and the variable selling and administrative costs are the same, income will be the same under variable costing. The purpose of variable costing is to reduce the manager's incentive to overproduce, to overstate income, and possibly get an unentitled bonus. That's it on variable costing. Give the exercises a shot. Do well.